Well, our third and final speaker this morning is Mr. Arkadi Nachimowski, who is the Managing Director, Head of Chemicals EMEA at JP Morgan. Prior to joining JP Morgan, Mr. Nachimowski worked for 8 years at Deutsche Bank and 11 years at UBS, and he's also qualified as a chartered accountant with Pricewaterhouse. Welcome to the stage.
Good afternoon. Your Excellency, distinguished guests, ladies and gentlemen. It's a great honor to present to you here today. I would like to use the next 20 minutes or so to provide you with a market perspective of what happened in the chemical industry over the past year. I want to touch on how investment thesis in the industry and generally the focus areas of chemical companies have evolved in the recent past. Let's turn to the first slide. Here you can see a snapshot of chemical market performance over the past 12 months. This year, we had quite a bumpy ride. But with chemical companies bouncing back from a first quarter low to end the year comfortably above the general market. This year can be characterized as quite unpredictable, to say the least. First, we have global growth concerns, mainly driven by China in the beginning of the year. To reverse these, in the second quarter, we had economic stimulus boosts both in China and European community, with the latter effectively reducing its interest rates to zero, announced another dose of quantitative easing. But the relative calm lasted until the unexpected win of the Brexit campaign in the UK, with the pound dropping by over 10% and continuing to slide. And finally, we had an unexpected results in the US election. So it's been quite a year, and amazingly, chemical companies' performance across sectors has been very good. But main issues still remain. We have volatility, political uncertainty, lack of growth, and we're still in a very low interest environment. Now, this chart shows the VIX index. That's commonly known as the fear index in the financial community. The higher the number, the more fear there is in the market. And it is an important indicator as it reflects potential investment behavior into real economy. So at the height of the last crisis, both US and European VIX indices were over 80. As we just discussed in the previous slide, there is unprecedented level of uncertainty in the world, both last year and going forward. This year, we have European elections coming up in Germany and France, with Italy referendum starting us off. Uncertainty of the new US administration, commodity prices, both oil, hard and soft commodity, where will it go? Brazil economy, movement interest rates going forward. So it's incredible that the VIX index is at one of its lowest points since the inception of that index. So today, in the Eurozone, we have 21, and in the US, we have it at 13. The market is calm and has learned how to deal with the current events and political changes. So long as results is definitive, then the market is able to predict and price it in. Now, growth rates across the globe have come down significantly over the past 10 years. What's interesting is that growth is low in both developed and emerging markets. The differential in growth rates between regions has come down significantly. This is a conundrum for the chemical industry, as companies cannot just easily buy growth. Emerging market investments does not guarantee growth. In addition, CapEx returns in these markets are uncertain and volatile. Investors now expect more bottom-up stories to feel comfortable with significant investments. For example, electric vehicles, batteries, lightweight materials have a structural angle, or there are some specific regional growth investments which need to be carefully explained. On top of that, higher volatility in exchange rates, and especially US dollar strength, make such relative investments more challenging. As you can imagine, investing in emerging market today but profits tomorrow may be very different in US dollar terms. Now, this is a little bit of a busy chart, but it just wanted to indicate that we are living in a new paradigm, where we need to pay for the privilege to lend to the governments, as you can see from this slide. Most of the European sovereign yields are negative, as well as Japan. So governments and central banks trying desperately to incentivize companies to make investments. But the reality is that companies retain their historic hurdle rates and shy away from more aggressive investments. The hope is that the new growth reality and low interest rate should make companies reevaluate their investment decisions and lower these hurdle rates. But most companies retain the expectation that current low interest rates environment will reverse, that the world will get back to normality of growth, inflation, and higher interest rates, and therefore unwilling to change the historic hurdle rates for any investments. However, we do have an example, and that is in Japan, that such future expectations may not materialize, and they are now living through over 25 years of low growth and interest rates. Now, we tried to test the theory of potentially higher interest rate by looking back since crisis in 2008 and 9. Now, what you see here is each year there's a consensus. There's a lot of financial analysts out there in the world, and they make a consensus of where interest rates likely to be during the year. So you have the high, the median, and the low. In 6 out of 7 years, the actual interest rates was touching the low end of expectations. So we already had a long term of low interest when looking back. So the question is, when forecasting future projects 10 years out, it's not clear why interest rates should be any different. Now, turning to oil price. This slide should be quite familiar to you already. A lot has been said about low oil price environment. I just wanted to add a couple of observations. First observation, I find that the oil companies see value in their chemical operations again, falling back in love with them, at least for now. Therefore, there is effectively some redistribution of profits regionally, with European commodities becoming profitable again, but also major tailwind to specialties and diversified chemical companies as they benefit from low raw material prices. But also, reinvestment economics become different given flattening cost curve with potential easier decision to invest closer to demand. Low profitability disincentivizes some companies to invest in existing plants, and some are skipping maintenance shutdowns, which lead to more and longer outages and generally tighter markets. And this had a major implication on profitability in many markets over the last year. The stocking in 2015 has not reversed in 2016. We continue to see mini restocking and destocking cycles, but not a clear trend. So the key question, how do you minimize this profit volatility that has been created as regional differences narrow? One trend is to capture more of the value chain or accelerate consolidation. But for now, I'd like to just highlight a little bit around the price and volume developments. With limited growth and deflationary elements like weak oil price have blighted chemical industry. And now, for 5 years, we see negative price developments in combination with low volume growth. Generally, CapEx investments have contributed to volume growth, but at the expense of price recovery. To counter this slow earnings growth and negative price development, companies have resorted to self-help measures. You can see on the right-hand side that these measures, in combination with volume growth and low raw materials, allowed the industry generally to improve profitability. However, self-measures that usually take 3 years to show full benefit are now winding down. Hence, the industry needs new measures to address earnings growth going forward. And this is reflected in earnings in the chemical sector in general. We've seen that earnings have grown for the whole industry, but generally well below the expectations from 12 months ago. Market expectation for 2017 is that low earnings growth will remain, although the expectations have improved during the year. But as you see on the right-hand side, there is no major rebound expected, with EBITDA expectations remaining muted for 2017. Now, chemical industry reacted with reduced capex going forward. The chart here on the left shows a basket of commodity chemical incremental global capacity growth over and above demand growth, so incremental supply growth. And you can see on the right-hand side that this slowdown leads to significant free cash flow expectations going forward. Generally, balance sheets in chemical industry are in good shape already. But this free cash flow generation will delever the industry further, with room to reinvest into other areas. Such high free cash flow is possible due to the extensive self-help measures in the industry has gone through just recently, like improvement in margins, net working capital optimization, as well as reduction of capex. Maybe also a good thing to note is that the market doesn't expect any pricing increases. So if there would be some pricing improvements, this free cash flow generation will increase even further. But for now, capex is not well regarded by the investor community, as it is accepted that growth will be lower for longer, and there is a lot of skepticism around pricing ability in the industry. Now, lower capex and higher free cash flow impacts capital allocation. Historically, as you can see on the left-hand chart, the biggest outlay was capex. This is true for industry as a whole as well as chemicals. Shareholder returns contribute a third, but generally investors in current low interest rate environment as well as low growth want management to reinvest the capital wisely themselves and not just give it back to them. Investors have the same problem. How do you reinvest the money that they receive? So going forward, we see that capex will be reduced with M&A and dividends increasing. M&A focus is especially true when it can be driven through long-term, cheap financing. R&D is also on the rise to capture downstream growth and become more differentiated, as well as creating barriers to maximize profitability. So, what do chemical companies want to fix? And what we try to show here is the commodity and intermediates have experienced high volatility. And it's to be expected, given the high exposure to oil price and macroeconomic swings. So you can see on the left-hand side the EBITDA margin as a proxy. You see a big swing in 7 percentage points compared to the other sectors. The least volatility in earnings is in specialties, as you would expect, as well as the highest EBITDA margin with lower capital intensity. That is why all the diversified chemical companies are trying to capture this and move into higher growth and higher margin businesses. Specialty chemicals themselves continue to focus on R&D, as well as add-on acquisitions to strengthen or complement their existing products with new or adjacent technologies. Now, the key question is also, does the market reward that? And chemical companies are valued on a DCF basis, but also using cash flow metrics, with EBITDA being a good proxy. You can see from these charts that all chemical companies have re-rated somewhat. That's on the bottom right. However, the biggest winners were specialty chemical companies. On the left-hand chart, you can see that specialties are trading at a major premium to the rest of the industry. On the right-hand side, you can see that they re-rated substantially more than any of the other subsectors. This highlights and underpins the attractions for the diversified to grow into specialties. Not only will they increase their margins and create synergies, but also have substantial re-rating potential. Now, what does it all mean? And yeah, well, As a bank, I can tell you that this has been a very busy year, as you can see from the left-hand side. So we have witnessed record M&A volumes over the past 12 to 24 months. You can see on the left-hand side that 2016 represents the highest ever chemical M&A volume at 170 billion. On the right-hand side, the bubble diagram represents major deals in specialty chemicals. And on average, how the multiples have increased over the past 6 years to record levels. In summary, this is a result of several factors: the high free cash flow, reallocation of capital, reward from capital markets in terms of trading multiples, need to capture structural growth and earnings growth, as well as low cost of finance. We believe this trend will continue. Now, this is a little different, but we have witnessed a significant acquisition spree into the United States as well. And one of the key drivers of this trend is the increase of new and now established investor class called activists. You can see on the left-hand side the growth of funds under management in that class, which grew dramatically over the past 15 years. Activists' tactics have evolved from being focused to optimize the company's capital structure to more sophisticated analysis now on how to increase shareholder value. They are focused on attacking corporate strategy, highlighting underperformance, increasing corporate clarity and governance through to breakup of and sale of companies. Now, what's important is to note that institutional investors now have embraced this activism. So there's no surprise on the right-hand side that we have many ticks regarding activist involvements when companies decide to spin off their business. These become much more bite-sized for other chemical companies to go and actually acquire them. Now, I must say that this phenomenon is mainly in the United States, but it is growing outside, both into Europe as well as into Asia. So here, a little bit of summary examples of different investment strategy which you see affected through M&A and other corporate actions. Downstream expansion, capture growth in new technologies and synergies. Example, how Evonik and BASF acquired companies, strengthen their existing specialty businesses with significant synergy potential, but also paying a full price. Industry consolidation, and here I'd like to just point out, interestingly, with the high multiples that we see in the market right now, many companies decide to do these deals as mergers of equal, to avoid any leverage and provide upside for all shareholders to participate in the synergy potential and other benefits like potential re-rating. Now, this is a busy slide with a lot of numbers, but we just wanted to highlight some of the statistics behind the presentation that I just had. We have witnessed a significant increase in strategic mergers and carve-outs, which you can see on the bottom left. These are transacted at higher multiples. And what you can see on the top right is that over 60% of all transactions were done with multiples that are above 10 times EBITDA. That is really a historic high. This has crowded out private equity deals and other investors as they cannot compete with motivated strategic buyers with synergies. And I think most importantly, just to highlight, that in the bottom left, you can see that emerging markets, especially China, have become increasingly active globally in global chemical M&A. So, in summary, the share price performance in 2016, despite all the macroeconomic uncertainties, has been very good for chemicals. Margin expansion through raw material tailwinds and self-help measures are coming to an end, and something new needs to be found. Lower growth and increasing free cash flow, leading to a shift in capital allocation away from CapEx. High M&A volume and multiples, expected to persist with focus on downstream expansion and consolidation. Thank you very much.